Good morning. Welcome to Stock Market Today. It's Thursday, February 27th, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at @DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider. It hits your inbox every trading day before the market opens. So U.S. equities closed mostly lower on Wednesday after a morning rally was not sustained. Technology was the only sector to finish higher on the day. Energy was the biggest loser. Treasuries were mixed with the curve steepening. Gold ended down 40 basis points. WTI crude down 2.3%, dropping for a fourth consecutive session. And as we get to the desk this morning, no let up in sight. Futures are down more than 1% to start the day. Asian markets were mixed overnight, with China outperforming. European markets are under pressure. Treasuries are stronger with the curve steepening. The dollar is weaker versus both the yen and the euro. Gold is up 40 basis points, and WTI crude down another 2% and is now off by nearly 10% over the past 4 days of trading. And as we look at the structure of the S&P 500 here, just as we were talking about yesterday, we cut through this support level like it wasn't even there. The morning rally yesterday faded. You can see if you look closely, this high wick on the candle, that was yesterday morning's rally. Tried to push higher and could not get there. We actually faded throughout the course of the day, leading to a fifth consecutive decline. Now, support is in the 3,000 to 3050 range. 3050 kind of lines up with the 50-day moving average and the breakout from the summer consolidation. Resistance is up here near this gap, near 3250. RSI becomes oversold again. You know, it's still oversold, and it's the first time it's been oversold since last August. And Chaikin money flow is now neutral to slightly bearish. So, you know, we're still probing and still looking for some signs of stabilization. Haven't really seen any yet. Maybe the 200-day moving average begins to come into play with the 1% decline that we're seeing here this morning. However, I think we need some time to stabilize here. A lot of fear, a lot of uncertainty in the market for the time being. We're going to look at some key breadth metrics a little bit later on in this show, as well as what's happening globally. But for now, I think it makes sense to give the market some time to kind of find its footing, stabilize. As always, manage your risk, right? We always advocate for having a solid and disciplined risk management process, and hopefully that has kicked in for you with this 5-day decline that we've seen here in the S&P 500. So let's hit our market in a minute. What are we writing today? We've already talked stocks fall for a fifth consecutive day. Breadth metrics in the U.S. weakened beyond last summer's lows. We'll take a look at what that means a little bit later on the show as global markets break down as well. We're highlighting key Fibonacci retracement levels in our note today. As you know, we get these declines. We've had that big run since the December 2018 lows. We want to highlight some of the key retracement areas should they begin to come into play. And as we said, futures do point to a lower open here today. So for the major indices from a power bar perspective, the Dow lost nearly 40 basis points yesterday. Further deterioration in the power bar, 1 bull to only 8 bears. S&P 500 down a like amount, 32 basis points, 37 to 111, bulls to bears there. The NASDAQ did buck the trend yesterday with tech heading higher. 12 bulls to 15 bears for the NASDAQ. Small caps, another big underperformer again, down over 1% on the day, 232 to 369, bulls to bears for the NASDAQ. Bonds as a group were down. Really, it was mixed depending on where you looked across the curve. According to the Chaikin Power Bar, large cap stocks are more bearish than small cap stocks. Major indexes across the board, however, are mixed. Let's hit our stock of the day now. And a stock of the day is actually one that I'm highlighting here. In my note to Chaikin Analytics clients, if you've taken that 14-day trial or if you are an existing client, you'll have read about Hess this morning. Hess has a very bearish Chaikin Power Gauge rating due to very poor financial metrics, very weak earnings performance, and very negative price, and very negative expert activity. Stock does have some solid technicals of late, although I'd call it choppy as best. But when we take the 20 factors, 5 in each of these 4 categories, we come out with a very bearish rating for a stock that has a weak trend below the declining long-term trend line and is in a weak industry group, right? Should be no surprise to anybody that energy is and has been weak. We've been highlighting it for what feels like forever now. As we take a look at Hess and why we're highlighting it as a bearish stock today, well, you have that very bearish rating being met with underperformance, right? So market and model are in agreement. At the same time, money flow is bearish, right? Stock is definitely under distribution, and it's overbought here in the near term with the overbought, oversold indicator beginning to move lower in an overbought condition. So on top of that, we triggered one of our sell signals today. Definitely a name you want to avoid. If you do trade to the bearish side, perhaps you want to look to see if there's a decent setup in the options. But regardless, energy remains an area of the market where we want to avoid. And some of the names in there that could present some opportunities if you do trade to that side of the book, Hess being one of them. Let's look at our sector tracker now, the movement of the major sectors of the market over the last 5 days of trading. Very similar theme playing out, right? Everything lower over the past 5 days with the big drop in the market here. So it really is, it's a function of looking for what's been less bad at this point. And the things that have been less bad remain the same for the third day in a row. It's your defensives, it's your staples, utilities, real estate, right? Kind of outperforming, right? In this case, meaning they're going down less than the overall market. That's defensive play. That's, investors running away from the more offensive areas of the market and favoring defensives. Healthcare, materials, industrials, and discretionary are middle of the road here. Obviously, all lower over the past 5 days. Financials being impacted by that big decline in yields. 10-year yield, as I was reading this morning, was actually below 1.3%. Comms, tech, and energy round out the bottom of the list. Energy just, really just continues to be an area of the market to be avoided. No end in sight for now. Obviously, we'd want to wait for a stabilization, but just don't see it yet. Technology under pressure, right? A lot of exposure to China and Asia in particular. So coronavirus obviously having an impact there. And comms, the bigger, more offensive names kind of weighing on that group. As we look at our industry in focus today, it's transportation services. Again, this is auto-generated, and I look at it for you in real time. And transports over the past 6 months have underperformed the S&P 500 by 3.87%. And the power bar ratio, which measures future potential, hints at more to come. 12 bearish or very bearish stocks for only 2 bullish or very bullish stocks, and the group is ranked number 15 of 21 subsectors, having moved down 4 slots over the past week. So obviously an area of the market we want to avoid. Some of the indicative names there. JB Hunt, JBHT with a very bearish rating. CH Robinson, CHRW, also with a very bearish rating. And Macquarie Infrastructure, MIC, with a very bearish Chaikin power gauge rating. So if you own these stocks, you have to kind of ask yourself, why do I own them? And if you're looking for potential bearish opportunities, should the market continue to move lower, this is some decent names to take a look at. As we look at the structure of the fund itself, its ETF rating is neutral plus, and that's largely a function of falling below the trend line here. XTN 12-2 bears to bulls weak trend below the declining long-term trend line. Now the fund has been an underperformer since December, and overbought, oversold is middle of the road. Money flow is mixed, really just kind of choppy at best. Doesn't look like anything we want to get excited about here in the near term. Potentially some support down here around the $56 level, lining up with the summer lows and the lows from last spring. Not quite there yet, just not an area of the market that's appealing to us in any way, shape, or form here. Very close to taking out those lows for those of you who've kind of followed the Dow and the transports, right? This is obviously a bearish sign. Should those lows be taken out. So watch that $56 level closely for XTN. Just obviously an area of the market that's impacted by coronavirus and general fears of global growth slowing. So just not an area of the market where we want to be focused for bullish ideas for the time being. Let's take a look at what's trending now. Yesterday's S&P 500 gainers and losers are movers and shakers. TJ Maxx reported solid earnings and same-store sales to send that stock higher by 7.25%. Gilead, potential coronavirus treatment, sends that stock higher as well. It was initiated at Barclays today with an underperform rating, so see how that stock trades. CME caught an upgrade yesterday at UBS, and I'll notice that the exchanges have been trading well of late. Obviously, volume and volatility bullish for the exchange stocks. Netflix, didn't see anything real company specific there to drive that stock higher by 5.3%, but as you can imagine, if people have fears around coronavirus and leading to a tendency to not go out as much or stay in. You can potentially see the benefit to Netflix there. Regeneron caught an upgrade at Canaccord, also initiated at Barclays today with an overweight rating. Regeneron up 3.5% yesterday. The loser side of the board, well, the top four names really have a theme, and that's in and around the coronavirus, right? Top three being the cruise lines. Royal Caribbean down 8%, Norwegian Cruise Line down 7.9%, Carnival CCL down 7.5%. Obviously, the travel, lodging, leisure areas of the market very exposed to what's happening in and around coronavirus, and those names are trading at or near 52-week lows. Expedia, in addition to being levered to the travel area or the travel industry, also announced a restructuring. That stock lower by 7% on the day. And Macy's just kind of trending lower following their earnings report on Tuesday. Stock down nearly 7% on the day. So let's dive into the charts now. I said we were going to look at key retracement levels for SPY, and that's what we have here. We're just looking at a straight up price chart of SPY. Right down here are those late 2018 lows before the big rally that ensued, right? Some choppy trading through the course of last summer before running to new highs. Remember, it was only a week ago that we were making new highs. So what I wanted to do is start to kind of lay out some of the key retracement levels, and just given the intensity of this move higher, you can see where those key retracement levels kind of line up, right? The 38.2% retracement lines up at around the 296 level, right near the highs from that summer consolidation. Just for reference, the 200-day moving average is right around here, 304, 305. A 50% retracement would take you back towards the summer lows from last year at around 283. And should it get that far, a 62.8% retracement takes you down around the 270 level that lines up with the June 2019 lows, also the early March consolidation and lows there. So I'm not saying we're going there, but I'm just saying that these are possible levels that, should this sell-off intensify, these are key levels to kind of have in mind, right? First stop, 200-day moving average, and below that, you start to look at these key retracement levels. Global markets also swooning here. Here's the ACWI ex-US ETF, the ACWX. What I point out in my note today is that I track 37 individual country ETFs. And of those 37 ETFs coming into today, only 6 of them were trading above their respective 200-day moving averages, right? The fund itself is below its 200-day moving average, having broke this uptrend line and broken below support as well. RSI, after a negative divergence, has become oversold as it appears to be shifting into bearish ranges, right? So momentum confirming what we're seeing here in price weakness for global markets. Now, you do have this big consolidation. Kind of looks like the Russell 2000, doesn't it? Big consolidation here throughout a lot of 2019. Maybe we see some stabilization there, but this trend to the upside has been broken. And we are in a downtrend relative to the S&P 500. And finally, look at the breadth deterioration. Percentage of stocks in the S&P 500 above their 200-day moving average falls below 50, also falls below the lows from last summer. Now, a sustained break below 50, such as what we saw in the fourth quarter of 2018, would argue for more downside for the S&P 500. So we're watching this very closely. In the intermediate term, same goes for the percentage of stocks below their 50-day moving average, right? We've fallen below those summer lows, and a sustained break below 30 would argue for further downside here in the S&P 500. Now, what I will say in the near term is we are getting pretty close to washout levels. The percentage of stocks below their 20-day moving average is actually 7% as we enter the day today. So while a near-term bounce can't be ruled out, it does appear that we've done some technical damage to the market here, and that's lining up with what we're seeing in the longer and intermediate-term breadth perspectives. And you can see I've drawn the trend line here on the S&P 500 from those December 2018 lows, and you can see we have broken below that uptrend line. So continue to manage risk. That'll wrap us up for today. Head over to ChaikinAnalytics.com/test drive to sign up for your trial. I'll see you tomorrow, folks.